are the sections of your organizations really speaking to each other? And what I mean by sections is really, does your operations, does your finance, and does your sales and marketing really speak the same language? And that's kind of the big basis behind the profit-focused accounting and the maturity model assessment that we put together.
All right, we have got a really good episode of the Modern CPA Success Show today. We're going to keep it internal, but we're going to talk about something that we have been working on, have launched recently, that I think could be a big impact to our clients, to our prospects, and maybe something other firms would think about using. Adam is my usual co-host. Adam, welcome.
Hey, how's it going, Tom?
I'm doing really well. And then we are lucky to have Jamie Naw with us today. Jamie is one of our directors. He was really the lead of this maturity model and helps us watch over the whole BCFO service. Jamie, welcome.
Oh, thank you. I'm glad you said lucky. There's probably a couple other choice words you could have used there, but I'm glad you said lucky. So,
yes. Okay, so I mentioned maturity model. Jamie, do you want to start us off? What's a maturity model and help people kind of understand what we're talking about?
Yeah, I can kind of walk into the maturity model space first, but I think it's probably more important for Adam to start off because, I helped build the maturity model, but really the basis of our maturity model is what we've been doing all along. It's that profit-focused accounting concept. So I don't know if Adam wants to talk a little bit on where that came from and kind of why we started using that and kind of the basis on that first, so our listeners really understand that that's really the basis of this whole maturity model thing.
Yeah, I mean, really, it was trying to come up with a process. So as advisors, you're kind of do everything advisor specific. You go back with your own experience and that kind of a thing. And what Jody and I wanted to try to do is come up with a system that every business, every small business could use to really operate with. And so there's just different checkpoints inside of there that we felt were really necessary to monitor and then make sure you have metrics around it and learn how to move the different levers. And so a few of those are, your production metrics. So it doesn't really matter if you're construction, manufacturing, or if you're a service-based business. Everybody kind of has, what are those levers that are moving the needle and doing those kind of things? Cash is another one of those areas. And then what are your sales pipeline going to look like? Whether you're in retail or you have an actual pipeline itself, it doesn't really matter. Those kind of areas of the business. And what ends up happening is people generally just go to one area or the other whenever they feel or hear a problem, as opposed to just having this system of like, okay, if we make sure all these things are kind of moving in the same direction and we're monitoring the different KPIs in these different areas on a regular basis and a routine basis, you're able to make like really small pivotal changes that don't require these big, massive moves down the road. So that's really the heart of the profit-focused accounting, was to make sure that all of our advisors were delivering and monitoring and thinking about all those same things.
Yeah, and so what it kind of came down to with all that is it was something we were doing for years. We were training our team on it. We're like, okay, this is how you advise clients: is you really focus on these areas and you make sure these areas are make sense. We were also using it in our marketing. Whenever we spoke about profit-focused accounting. We kind of had different sections on the slide, and so we talked about it. So if someone heard us talk, they knew a little bit about profit-focused accounting. All of our CFOs and team members understood about profit-focused accounting, but the question is do our clients really understand what we're doing here? And that's kind of where we came up with this maturity model, was that, we could use that profit-focused accounting to truly assess our clients during onboarding and then talk to them over time about how they're doing in those 5 areas we came up with. That, if you're progressing in these 5 areas, then the financial maturity of your business is getting better along the way. And really kind of the overarching theme it all comes down to is, are the sections of your organizations really speaking to each other? And what I mean by sections is really, does your operations, does your finance, and does your sales and marketing really speak the same language? And that's kind of the big basis behind the profit-focused accounting and the maturity model assessment that we put together.
Yeah, I agree. And as I think of before we had this, I would often look across my clients and think of the firm's clients and say, I wonder if there was a way to measure like which ones are doing the best in certain areas. And could you get maybe something around the ones who do the best up here? And it always seemed difficult to have any kind of measurable way about are they doing well or not. And that's where this came in to say, okay, yeah, we could actually put in place some measurements on each of these dimensions that we could come up with and have some kind of objective criteria around that.
Well, I think the other important thing is there's always a disconnect between where clients think they are and where we maybe think they are. And so we have that first self-assessment to say, hey, Here's where you think you are. And then we go through and have a more detailed view, and we can kind of explain the differences and the challenges that we see. And it's something, that is material that they can actually see on paper. More importantly, it gives us the opportunity. Obviously, you're not going to eat the whole elephant at once, kind of a thing. It gives us an opportunity to like talk to the clients, prioritize things, and let them know, like, hey, let's focus our attention here or there. And then later down the road, whether it's 6 months, a year, 2 years after working with us, they can actually see a scoring difference in how we're able to perform. So it's a way to also, kind of show off or flex our ROI to the client. Because ultimately, at the end of the day, the higher score is going to result in a higher enterprise value for the client, which is, all businesses, that's kind of the end goal, even if you're not planning on selling.
Definitely.
So Jamie, to help people further visualize, do you want to give them a description of what the two different axes are and sort of how we think about that?
Yeah, let's start talking about one, and then we'll dive into the other. So I think let's start off with the score system, the numbers. So Adam worked a lot on this. I know you did, Tom, as well. We tried to come up with 5 words to define the rankings, and I think we probably looked at 300, and which is a lot for me because I'm not really a word guy. But it was a lot of fun trying to choose the right words. But basically, what we came up with is a scale from 1 to 5, and what we used for that basis of the words is how are companies making decisions, right? So like at the lowest level, so level 1, we came up with ad hoc, and really the basis behind that is the company doesn't really use data to make any decisions. They're just making decisions ad hoc. They're making decisions as they come in. So that was level 1. Level 2 is foundational, which means they have enough data where they can make reactive decisions. They can make decisions after the fact, after things happen. So that's foundational. And then level 3, we came up with standardized. Now we're getting into some pretty high level thinking here where we're able to make proactive decisions. We're able to think about, okay, if X happens, we can do Y. And so they're trying to make decisions ahead of time. Level 4, and so again, 3 was standardized. 4 is integrated. Now we're talking about making strategic decisions. We're talking about decisions that have strategy in mind and have the future in mind. So that's integrated. Level 4. Then level 5, which is the highest, is optimized. And that comes down to real-time decisions. That if something comes up and something pops up, we're ready to make a decision right away because the data is at our fingertips right there. And so really we came up with those 5 levels, 1 through 5, and that's what we evaluate every section we're going to talk about on and say, okay, where are they in there? So there was a lot of data to fill in there, but let's talk a little bit about those 5 rankings before we kind of go into the topics.
Yeah. You touched on the words. I think it's great. Pick a group of accountants to say what are the best words, and that's where we'll force all of our time to go. So those words I think they're excellent. Something that you pushed us for right away was let's be consistent as we look across the dimensions, that essentially that word foundational would mean about the same thing in each of those areas. And I think that was really good that you kind of go to each one and go, okay, yeah, foundational is about the same. People start to get in the rhythm when we do these scorings that they understand what they mean from the beginning and get themselves there. And so I think that's really helpful.
Yeah, I think that subtopic made it easier to create the details of what each level means, right? Like just the way my brain works, I never could have filled out all these, if you think about it, there's 30 topics with 5 levels. You're talking about, a lot of data points there to enter. And I never could have done it without having those subtopics there to always lean back on and be like, okay, what is foundational? Okay, we're making a reactive decision. How would that look within this subcategory? So creating those sub descriptions was really helpful for me in working through this. And it also helped me do the review as well, like, because we obviously did this in departments. And so when we went through our review, and we also had other people review this, we have a group of clients on our client advisory board that we walked through this, and they gave some really good feedback. And I think there were some inconsistencies there. We're like, well, you guys are saying this is level 3, but that's actually probably more level 4. And we were able to get that feedback because we created that sub description there that really, was almost like the compass for filling all this information out.
Yeah. And as I remember, and maybe I don't remember the history well, but I remember we came up with the titles and then divided up the categories and came up with scoring. Mm-hmm. And predictably, we decentralized it. It wasn't consistent. My memory was then Adam went through maybe for the first time and looked and probably saw just how crazy it was that you could go from a 3 on one category that might sound pretty good and a 3 on the next category sounds terrible. And I remember lots of comments about, I can't even tell a difference between the way you've described a 3 and a 4, for example. The other thing, when I think of the words, other point I'll make is it feels like when we first started, they were pretty judgmental sounding. Like a 1 was really critical sounding. You wouldn't want to be that. And the 5, And they're a little bit like that, but for the most part, okay, you can do things ad hoc that might actually be okay and work for a certain kind of a business, and optimize might not be something that you need. And so I think those titles sort of lack judgment, that it is what it is. Now we'll talk later about how we use it, but I do like the way we scored it that way.
Yeah, I think that's one of the essences of the maturity model is it's not anytime someone sees numbers, they think of a report card, right? Like I want to be all fives. I want to have the best grades possible. And that's really what not the purpose of the maturity model is. In some areas, it's okay to be a 2. It's okay to be a foundational in some of these areas if that's what your goals as a company are, and that's what your goals as businesses are. So we kind of had to redevelop those words so every one of them was okay if that was what your goal is. Like you don't need to be able to make, there's very few businesses that need to be able to make real-time decisions all the time in every single area. And so like a company that was a 5 in every single category is spending a ton of money to be a 5 in every single category. And sometimes that's not worth all that money. Adam, any thoughts? I know you were a big proponent on the words. I think the part that Adam, there's some pet words, and if you've heard me talk before, I use the word excellence a lot. It's one of my favorite words. And I obviously tried to sneak that in there. And Adam's like, nope, that's not one of them. We had a lot of good discussions about what those right words, but any thoughts on the words we came up with?
No, I mean, like you said, I think the biggest thing is just making sure that they're actionable. I mean, that they're relative to everybody's situation. And I think that it definitely took a lot of conversation, but I think we got there. So
if you double click on a couple of those, Jamie, we had some things around automation and controls and some documentation. Do you want to talk a little bit about how those related to the scores? Because we were somewhat consistent across those, how those fit into like optimized versus ad hoc.
Yeah, and I think there's a lot of details that go into like those high level descriptions that we have, and so I think there was a lot of things we looked into in terms of those subcategories, and we did create a subcategory matrix, which we can always share with the listeners. But yeah, I think it really was like, okay, with how does your data look, how does your reporting look, and so what we tried to do under each of the subsections is if we talked about records within ad hoc, we made sure we talked about it at all 5 levels. Or if we talk about reconciliations in level 1, we talked about it at all 5 levels. And so that became part of the challenge. And the way my brain always works when it comes to doing these things is what's level 1 and what's level 5, and then I kind of fill it in from 1 to 5, then I fill the 3, then I can easily do the 2 and the 4. So that was a lot of the ways we had to do it, was like what's the best, what's the worst, and then what's the middle, and then we can kind of fill it in there. So there was a lot of that going on when it came to filling out those individual sections.
I agree. And one of the hardest things when we were coming up with the definitions for me, but became really important, was to get as objective as you could.
Yeah.
So things like, and accountants understand closing things, you're getting into things like days that it takes to do closing, and are all the accounts reconciled that are in there? And do you have processes documented and things? It makes it a lot easier. I think that is much better than getting to like what's your level of comfort with something, because Jamie's level of comfort and mine or the business owner could be very different. So the more we get objective, and I'll talk later about, as I've done this with people, I've been surprised my clients haven't been more defensive. And I think it goes a lot to credit because it's objective, that they're kind of going, well, and I've heard this a lot, by that definition, I would be a 2. Yeah. And I think that's a really good way that they can do that versus something that is subjective that they want to argue because they, to your point, 2 is a scorecard and that's a low score. I don't want a 2 on my scorecard.
Exactly. So let's talk about the sections. I think that'll bring some light in here, and I think I'd like to go through them one by one and allow you guys to elaborate on each of them. But really, the first section. So this is the one we had to add, and this was something that was interesting because we had our 4 sections of profit-focused accounting that we always talked about, but the underlying road of all of those has always been financial reporting, right? It's really hard for us to do a forecast if your financial reporting is terrible. It's really hard for us to predict cash if your financial reporting is terrible. All the other subsections we decided were really hard to do if your financial reporting wasn't accurate and timely and all that stuff. So this is the section we added to profit-focused accounting that, again, was always there, but not called out. So the first section is financial reporting, which is kind of broken into these sections. So we had accuracy, timeliness, process, automation, tax compliance, and planning. And then the other one that fell in there was risk management. So again, we don't need to go into all those details, but I think, you want to talk a little bit about financial reporting, Adam, and kind of why that really had to be there in order for this to make sense.
Yeah, that was kind of the one that we struggled with a little bit because it's not something necessarily that we think about maintaining because we own it, but at the end of the day, it's garbage in, garbage out. And so we thought it was really important because it was a huge roadblock for the rest of the other items. So if that wasn't in order, then it stopped us from being able to do the rest of our job. And I think it was important to call that out to the client because a lot of times that's the one that we have to end up prioritizing at the beginning of the relationship in order for them to get value out of this stuff down the road. So, whenever we went into the financial stuff, we just needed to make sure that, the books we always talk about, make sure they're high and tight, and make sure that, things like revenue rec are in place and all those kind of things that make it possible to rely on the information.
And I also think adding financial reporting into this process made our onboarding process way more clear, right? So we've always kind of said that, one of the first things we have to do is get your books clean before we can go into the rest of onboarding, but allowing us to use the maturity model to go in there and say, your financial reporting, you're 1 in 4 areas and you're a 2 in the other. We want to get you to at least a 2 before we could touch some of these other things. Tom, do you want to kind of talk about how that's worked in your onboarding so far?
Yes, and we've had cases where in onboarding, someone is talking about what I want is real-time dashboards that I can look at and get this kind of information. And when you look, their books are a mess. The books aren't closed and they're not accurate. And sometimes that was an argument that, they sort of want to ignore that part and say, but I really want these dashboards and you're not delivering the dashboards. And we could find ourselves in places where the team has worked for months to clean up the accounting and the team is doing a fantastic job and they're proud of it. And then the client's upset because they're like, I was told that onboarding would be a short time, and we'd communicate all over. The reason we're taking so much time is because your books were a mess. So the maturity model allows you to say, maybe it's 1s and 2s across accounting, and they're agreeing on that, to be able to say, I can get you there in the dashboards, but exactly what you said, Jamie, I have to get you to a 3 or 4 where I can trust the data, or you're going to have a pretty picture on your dashboard that doesn't tell you real information. And I have found that good because as we talk more process, we do prioritize where we're going to make improvements. Mm-hmm. And so visually, it's very obvious, as you mentioned. Did you say there's 30 mentions? Is that right? Yeah. If you end up saying, okay, what's the priority? 20 of them are high priority to get this better. Anyone can look at that and say, that's not reasonable. You can't have 2/3 of the items that are high priority to fix. So it makes it a pretty reasonable conversation to say, okay, I've got these 3 on here. Here's what we're going to do. And the process now. As soon as this is done, we're picking a couple more and we're going to keep making this improvement, and they can see the progress that we're making. So that's where I think it's been really valuable. And I've used it just for that I have a client and part of it's a mess. And I didn't like some of their accounting. And so it was really good to be able to say, this is high and here are the specific things we talked about that I really want to focus on, because they are in that category where they want the good dashboards, but the data is not clean underneath.
I think it also allows us to have that, because it's visual, allows us to have that conversation you're having a lot easier. And it's easier for a client to understand. Right? In the past, I know I've explained this to clients before, but they don't always hear it. But I think the fact there's a picture where I can say, with financial statements being inaccurate, sure, I can build you a forecast. The forecast built on inaccurate information is not good. And what might happen to you, Tom, if you're my client, is I might tell you, yeah, sure, go ahead, you can buy that building. You have plenty of money and your forecast looks good. And then we go and clean your books and we find out, oh, wait, the last 4 months of revenue has been overstated. Actually, you had a really bad 4 months. You should have never bought that building, right? And we've all made that mistake because the financial statements
are
I
haven't.
I think you haven't,
but you have.
The rest of us have. But I think it's a lot easier to be able to warn the client that that's what will happen if we're trying to build a forecast or talk about cash without having a really good understanding of what's going on in the books.
Yeah. And I would say from the beginning, I would imagine most of our listeners have had this experience. Many of our prospects, when they come to us, tell us they think their books are in pretty good condition. And sometimes that's true. Oftentimes owners are surprised when we're getting in and saying, here's what we're finding. And that can be uncomfortable. And the maturity model is sort of an easier way to work your way in and get some very specific things that you're looking at. Because we can look at their books and sometimes you can tell, as everyone knows, you look in QuickBooks and it looks like a mess. But then you can also start asking some questions and then they can start seeing what that looks like. Take some of the emotion out of it.
Definitely. As a CFO, Tom, how involved do you get in the accounting? Because I know, we always pair up the team and you have somebody on onboarding that helps out. How involved do you get in on the understanding the maturity of the financial statement section?
Yeah. So in the onboarding, all of our clients, like you said, we have a senior accountant that works with me as a CFO, and we have 2 different tracks of discovery, advisory discovery and accounting discovery. So the accounting discovery, I'm not usually in the meetings with the client, that there's a whole list of things they're going through to look at the accounting, but I'm probably doing 2 or 3 different reviews with the senior accountant where they're saying, here's what I found. And usually it will be similar to a month in review where they might be showing me the balance sheet. And I've had cases where they say, hey, everything looks really good. And then I can point to something on the balance sheet, like, what is this like $1.1 million owner loan? Something like that. And they're like, oh, we didn't get into that. And so it's a chance for you to look and say, hey, let's really it gives me a chance to make sure that it was gone through on a thorough basis. And then I've also sometimes watched the process intake where we're talking to the client about their processes, but more often reviewing with them, what did you learn about these different processes and are there controls in place? Mostly an oversight kind of role.
Great. Yeah, no, I think it's really important that the CFO has insight into this and understands how it works, why it's working which way, and what level of is the financial reporting at, and how can we up level it? Because oftentimes the senior accountants can go in there, they can do the reconciliations, they can clean stuff up, but they're going to need some CFO help to get from that 2 to a 3 or that 3 to a 4. I'm like, what does that look like, and how does that process look? Because oftentimes it's about efficiency, and I think senior accountants oftentimes are really good at accuracy, but the efficiency part, they need a little bit of a old head in there to come in and be like, hey, if we can make this a little more efficient by doing some estimates or doing some of these things that are going to help us get things ready a little faster.
Yes. Yeah, that's a really good point.
So the next section of our maturity model is cash management. So if anyone's ever heard us talk, they know we're big cash guys. We want to make sure companies have the right amount of cash in the bank. And so cash management is our next section that we kind of walk through with the clients. And there's 5 sections within cash management. So there's cash reserve, tax reserve, the relationship with your banker, investing, and debt management. So those are kind of the 5 areas that we evaluate all of our companies on when it comes to cash.
Yep. And with a couple measures, do you have enough cash? And I've got an example where a client doesn't have enough cash. They acknowledge that. And for people who know what we teach, we suggest if you take a trailing 12 months revenue, you have between 10 and 30% of that amount of cash based on the risk in your business. I have a client who's very low, and on the investing section, they're at a 1. They have no investing strategy. At the moment, they're comfortable with that because they don't have the cash. So it doesn't really make a lot of sense to spend a lot of time. What am I going to do with this cash I don't have? And so we've said that, I'm okay. Let's not prioritize this to be better. Let's focus on getting you more cash. And I would love to have the problem of we've got enough cash and we don't know what to do with it. We need an investing strategy. So that might be an example where, unfortunately, because of how their business is going, a 1 is okay in this particular dimension.
And I think with cash, it's the one area, a lot of these, we feel like we can get companies up to a 3, if not a 3, a 2 by the end of onboarding. And that really is a lot of what we've been doing all along is like, okay, you didn't have a forecast. Now you have a forecast that you can access at any time. That just moved you from a 1 to a 3. But when it comes to cash, this is the slowest moving one, because I wish I could get you from having $0 in the bank to having $500,000 in the bank in 8 weeks. But that's not going to happen with a lot of companies. So this is the slowest moving one of a lot of them. And so that's really important for us to establish those timelines with the goals when it comes to cash.
Yeah, great point.
Or you can just get the owner to stop spending all the money, and then, then the cash magically shows up. So, yeah, it is an interesting conversation because this is a point where the clients get a little bit bullish sometimes on where the money is located. And I get it, from a concentration standpoint, you don't necessarily want a ton of money in the business. It's exposed from a legal perspective. And so the 30% is kind of is probably on the extreme side. But typically 10 to 15% is probably what you'll see in most cases. And that's generally sufficient if they have a pretty good cash cycle. But we can do the math and we can show it to them and why it matters, and they can easily look to how many payrolls that is, oh, that's only 2 payrolls. Yeah, we're not asking for a ton of money here. So yeah, I just think it leads to a lot of interesting conversations. And as you mentioned, Jamie, it is the ultimate lag indicator. And so this is also a spot where we can kind of express the value of the forecast being the map to get us to this destination. At the end of the day, if we want to improve enterprise value, we've got to improve EBITDA, right? Because that's what people are going to get paid on. Well, whenever we improve EBITDA, what happens to cash? Unless there's a ton of distributions, it's showing up on the balance sheet. So it's just always, I think in every single one of these instances, it's really easy to kind of point back to the forecast and the importance of the forecast and how we're going to use that as our as our navigation point and our foundational tool.
Yeah, and I think it also, to Adam's point, like it allows us and it gives us the avenue to have those tough conversations early on. Hey, you're having a retreat every other month in these exotic locations and you're spending, $200,000 to do that. A good way to save some cash is to maybe cancel a couple of those and build some cash reserve, or have a client that just spends crazy amount of money on in-office food. And like, I'm getting on them for a while to be like, you could cut some of that back and we could build this cash reserve pretty quickly, or you could just keep doing what you're doing and it's going to take us twice as long.
Well, I mean, I had a client recently where I had 3 owners, and probably the smallest owner of them all, the minority owner, was like in charge of operations, and they looked at their cash account and they're like, "We never have any cash." And it's because the other owners were like, "Hey, this is a service-based business. We believe that it should always just self cash flow, and it just is what it is, and we're the owners, and we're just going to grab all the money." And so whenever I came in and I was like, "Hey, no, we need to establish this policy," he was just like, "Oh, thank you. Like, I've been trying to get them to leave some cash in the bank, because they're not the one that has to run payroll, and then like see these ebbs and flows. And whenever a receivable doesn't come in and I need to borrow from the line of credit, they get all bent out of shape." And, the story that I always go back to, and it's happened to me more than once, is that, and I tell owners this all the time, is like, if Jamie and Tom both want to take money out of the company, cool. But if I go to Jamie and Tom, I need both of you to go, "Hey, remember that 500K you guys took? Need to bring it back to make payroll." Well, I can tell you what happens is Tom says, "Yeah, absolutely. I'll deposit it tomorrow. Which account do you want it to go into?" And Jamie goes, "What $500,000? I don't have that." And so, yeah, so it's like, "Hey, you remember that boat I got?" And it's like, oh my gosh, so then you have one partner having to come to the table with cash. That creates partner issues. So I always just tell people, it's like, hey, it keeps the peace, it keeps everything going. I'm not asking you to put tons of money in here. Again, I can show you the cash cycle, how that works, how many payrolls it is, all those kind of things. 10% is usually about 2 months worth of expenses. That's not asking for the world. But you do need to diversify a little bit. We know that there's some limits to what the Fed, reserve, guarantees in terms of that kind of stuff. And we saw some scary stuff with some smaller banks. So it's not that we're tone deaf to that, but you want to make sure that there's no business interruptions due to poor cash flow. And this is the best way to do it.
Definitely.
Yeah, important to mention.
So the next section is we're starting to get into some of our smaller sections now with less subsections, but it is still really important. And it's we call it profitability, but basically it's making sure you understand your income statement. If you're going to understand cash, you're going to understand how your business runs. You have to understand, what your revenue drivers are and what your income statement is. And so the next section really is, because we call it profitability. And there's only 3 subsections to that. It's benchmarking, it's valuation, and financial KPIs. So again, what depth do you understand your income statement? Not just at, I know how we're doing, but how does it compare to the industry? How does it compare to our expectations? How does it affect the value of our company? And so that's kind of the next section we really want to make sure our clients have a good understanding of, is that profitability.
Yeah. Each of those categories, the better you get, or the higher you go in the scoring, whether it's benchmarking, valuation, or I'm forgetting the other one. KPIs. Thank you. It's how are you using them to set goals and targets, right? So on one hand, if you think benchmarking, like, I don't even know what the benchmarks are at the lowest category, and then you might be able to say what they are, but are you actually saying, do you know you lag, that the industry might be a 50% gross margin and you're sitting at 35? Am I setting goals to work my way to where I understand what the reason is why it's lower and what I can do to make it higher, and then starting to work my way that direction? That's when you're getting to those higher levels that are in there. And we see that with a lot of where they might have a valuation for their company, but you're saying, okay, but if it's lower than you want, you got a multiple that's really low compared to the industry. What are we doing so that that's a higher number, so that if you decide to take an exit, you get the most that you can?
Yep. Have those conversations on a pretty regular basis. Just had that one actually with a different client the other day, because they were cash flowing. They have no debt, finally paid everything off. And they're like, "Hey, just enough money. I'm good." And I'm like, "Cool. So whenever you retire in 5 years, your business is approximately worth this." And they're like, "Oh, well, that sucks." And I was like, "Yeah, I agree. I don't like that number either." Because what we talked about was, over the next 5 years, you're going to be putting away this amount of money, which the cash is There's enough barely in the company to be able to do that. You're going to basically bleed it dry of the net income every year to be able to do this. It might end up with a small deficit every year to hit your savings goals. But then ultimately, at the end of the day, you were going to hit this bogey with your purchase price. And that was what was going to allow you to retire. But because you're off these metrics, from the industry that we should be able to drill into. Now, operationally, you need to figure out, like, let's have conversations, like you said, Tom, about why we're off. And, sometimes it's okay. Sometimes it's up here instead of down there. And, you kind of move those things around. But those are great conversations to at least investigate. And then I said, hey, and then I put together a quick thing like, this is how much you have to reduce expenses by, or this is how much you have to do sales by. And here's a combination of the two. Go find me $300,000 in revenue and go find me $200,000 in expense savings, and we'll hit that bogey. And they're like, okay. And then they came back and they had this really long list of everything, all the initiatives they were doing, all the things that we looked at that they were off, and they're digging into them and they're changing different things. I was like, well, if you can do all that and we can do that for the next year, then we'll get our valuation back up.
And I think the important thing is having the understanding of what it is. Like the example I use when I onboard clients is I say, we've all had that feeling in our 401k, right? Where the quarterly statement comes and it's one of those bad quarters for the economics. And you look at it, you're like, what? My funds only grew by this amount. That's crazy. Did you get that pit in your stomach when you see that report? But no one knows that when they're running a business. And the problem with there's a big difference between a 401k because you kind of like put that money and you forget about it. But with a business, it's like, oh, the quarter happened. And guess what? I just put 500 hours into this quarter and that was my business valuation, right? So like you want to make sure you understand, is your business going up, business going down? Because that's ultimately what this business is worth to you. And you want to, if you're putting that many hours into something, and not only hours, you're putting that much money into something, you want to make sure it's growing and not just sitting there stable.
Yeah, I think the other thing is too is how these all interplay together is like I said with that valuation. I know we talked about it in cash and what kind of relationship do you have from like an investing, financial advisor or somebody like that. One of my questions is like, what's the number? I think one of those financial institutions had that commercial program, but that's legit. Like, what do you need to retire? What do you have in Social Security benefits? What are you going to get in Social Security benefits? What are you going to have nested up, that you'd be able to draw from? And then what do we need to solve for with the enterprise value of the business? Once you start making those connections to people, and then, if they don't, again, you hook them up with a financial advisor or whatever, so they can figure out what that number is. Even if they're 36 years old, it doesn't really matter. Like, you're still running at a target. You want to know that at the end of the day, I'm covered if I need to, that kind of a thing. So having those conversations and connecting those dots between these different sections is really important.
Yeah. Excellent point.
So the next section is one that I've probably said this word 50 times already in this podcast. And so it's obviously a word that's near and dear to us, but it's the category of forecasting. And so when it comes to forecasting, we're really looking at three different areas. What are the non-financial KPIs or the revenue drivers? What's your understanding of gross profit? And then what's your understanding of your revenue capacity? And so that's really the elements that we use to help build a forecast. And, it's a lot of times when you're talking about forecasting with the client, we are talking about non-financial stuff. Like what drives your business? What really gets your business to do well and not do well? And so that's really kind of the essence of those three categories, is understanding your business at one layer deeper. And the fun thing to me about forecasting is a lot of times the company already knows the answer here, but they're just not focusing on it. Like they know what drives their business. They're just not paying as much attention to it as they probably should be.
Yeah, I agree. And oftentimes we'll get owners who will have goals. I want to grow by this percent, or I want to have this top line number, is often a vanity goal that they have. But if you know there's revenue drivers, you're getting in, okay, what would it take if you're here today and say that's 30% bigger next year, what's going to be different? Let's break it down into, is this a sales problem? Is this a product problem? Is this a service delivery problem? What are the different things we have? And when you're looking at cost things, we can look and say, we're seeing what's changing in here and challenging them to say, if we're trying to get cost out, like Adam, I think you said $200,000, helping them with that and saying, would that be people, or are there other things they're spending money on that we're suggesting that? And then you can forecast out and say, this would be the result if you can do those things and show them. Usually it could be a pretty dramatic increase in profit if you can hit it. But then you start focusing on what's it actually going to take to make those changes.
Yeah, I think that's a great point. I mean, that's the difference is you do hear that vanity metric a lot, like, hey, I want to grow by 20%. I want to increase my top line. It's like, how? You know what I mean? Like, and to your point, like once you dig in, and it's like, cool, you need to do, 40 more of those. And it's like, oh, production team raises their hand. It's like, I can't do 40 more of those. We don't have the machine for it, or we don't have the people for it, or we don't, whatever the driver is, it's like, oh, okay, well, now we know we need some CapEx spend too, because we're going to have to invest in a new piece of equipment, or we're going to have to hire some people in order to make that happen. That's going to change the forecast. So those drivers really are an education point for, and even if it's the same person, it's the business owner, is the salesperson, and the operations person. Having those drivers go one layer deep really just kind of drives it home for them, going, oh, I can't make 3,600 sales calls a day. That's not possible. You know what I mean? Whatever the example is, and it helps you get to what's more realistic.
Yeah.
Yeah. Forecasting is my go-to when it comes to sales. If I'm at a conference and I'm working a table, or if I'm doing a sales call, it's one of the first questions I ask is, tell me about your forecast. And I'd say about half the time the answer is, oh, once a year we sit down and we build this budget and this is what we follow to. And I'm like, well, that's not actually a forecast. That's a budget. And I ask questions about doing it monthly, like, oh, that's a great idea. And if they do happen to do a monthly forecast, then I start asking questions about, tell me about that forecast. How often do you look at it? How often do you think about it? And like, yeah, we just kind of do it because we have to. And so like to be able to like talk through that and walk a client through how important, or potential client, how important it is to live and breathe that forecast and have someone doing that for you is such a value add that this is the area I go to the majority of the time when I'm trying to talk to someone new about like what we do, because I really think it's the highway by what we do. Like it really is the basis behind everything we do. And so it is that important.
Yeah. We could easily go into a whole topic around that, but I agree that the better you are on that, and then many of our people, I've got a few clients who are struggling. They want to do different models. What if I modeled this happening and that happening? Well, if you can start with the forecast of, I believe this is correct for how my business is running today. If you think that's right, then it's really easy to say what would happen if I changed and got rid of 2 people, or if I grew my top line by this or did this and that. If you don't have that from the beginning, you're just really in trouble with, you don't know. And so you may end up saying, I'm going to fire 3 people and find out that wasn't the right solution for you to do. And here you've just really hit your business hard, or maybe it was a really painful thing to go through and that wasn't enough. And now you're coming back for a second round, which is much more painful than the first round.
Definitely. Okay, on to the last section of our maturity model. So this one was another bit of an argument internally, because the word we always used was pipeline. And this was a fight that I fought when we created this maturity model. Is like, pipeline only applies to certain companies, right? If you are a company that has a sales operations, or you're doing sales calls, then a pipeline is really important to you. But a lot of companies don't have a pipeline, but they still should be looking at what their sales outlook is. And so after many rounds in ChatGPT and pulling out the old thesaurus, we went with the word sales outlook. So sales outlook is the last section here. And basically there's 4 drivers of that. First is understanding the drivers. Second is capacity. Third is having a process around sales outlook. And then last is what tools you're using for your sales outlook. So this one is obviously super important, and something I get really passionate about is it's awesome to build a forecast, and it's really important to build a forecast. But if your forecast thinks you're going to have $500,000 of revenue for the next 3 months, but everything else is telling you're only going to have 200,000, like what are you going to do with your business? And so it's really important to understand where that $200,000 sales outlook comes from, and that process is around doing those predictions.
Yeah, and especially as organizations get a little bit bigger with either multiple salespeople or sales and production, that's where some of these measures can get really good, because we've had cases where it's 2 salespeople, and so now a CRM tool or something to track all your prospecting is really important, that everyone knows what the deals are and it's got the right follow-up. Or maybe sales and production aren't talking. And so you could have a case where hopefully the sales team is doing great, and all of a sudden production is saying, we can't service these kinds of things. And so that also comes into, like, are those groups working together so they know what's coming? Adam, I think you used the example that the team saying we can't make that many. So are those 2 groups working, knowing what's about to come down the pike, and so that you can meet customers' needs?
Or the opposite. I mean, I use it for, I think this is the important part of, the old saying, like, I've never met a forecast that I didn't like. You know what I mean? Like, all the numbers look good whenever you throw them out there, but whenever you back in at least a short-term outlook, like things that you know to be true, whenever you put that back into your forecast, what does it look like? Are you cash, because you can instantly see in a dynamic forecast, yes, what it's going to do to profitability, but what's it going to do to your cash? What's it going to do to the bank account? Right now, like after this call, I'm going to be meeting with a client and I'm going to be explaining to them what their cash looks like at the end of the year based on their next, actually for this client, I have the next 5 months worth of pipeline pushed in there. You know what I mean? I have the booked work that they have. I know what their likely scenarios look like. I know all those kind of things. And I can say, hey, like we're built for this. However, this is what we know to be true right now, and this is what it's going to look like at the end of the year. This is what our bottom line is going to look like. This is what our cash is going to look like. We good? That kind of a thing.
Yeah. So Jamie, we've gotten through all those dimensions. Do you want to talk a little bit how we're using it currently with our prospecting? And then we can talk about we've talked a little existing clients. We can probably touch on that a bit more.
Yeah, so the couple ways we're doing it with our client prospecting is we've created a survey on our website. So if you guys go out to our website, you should be able to find it where companies can come in and take a real quick evaluation. And it's only 12 questions, I think. It's less than 15 questions for sure. And they can answer those questions and they can get a real quick evaluation on it. So it basically says, here's where we think you stand and this is how you could be doing better. And it helps them. The first question is what is your goal? And so we came up with, kind of 4 or 5 things that a company would be using as their goal. And we use that to essentially create that baseline of this is your goal. If you were to do this better, if you were to do a better job with your sales outlook, then you might be able to reach that goal a little bit sooner. So that's really that survey that we're pushing people to. And then also it's allowed us to put better presentations around profit-focused accounting because we've always done profit-focused accounting presentations, but now we have something we can tie it back to. Like if you want to learn more about all we're talking about and see where you stand, go and take this form on our website. So that's really how we're using it in prospecting.
Yeah. And so as we give talks, you're often having people in the audience take it there, plus they can go to our website, right?
Yep, exactly.
Yeah. Yep. And then I think you mentioned this, but I'll make it clear. They're getting an output from that. It is not just a survey that pops up and gives just a score or something. It's going through the dimensions and helping them understand, which is the beginning of, hey, if you worked with us, these are some of the kinds of things that we'd be doing to give them a bit of that taste of what that's like.
Yep, exactly. That, and then also, Adam, you want to talk a little bit about how you use it on the sales calls when someone comes in the door and they start talking to us about possibly working with us?
Yeah, go ahead. Go ahead, and I'd love to actually hear your perspective on that first, and then I'd like to hear how you do it on your sales calls, really quick.
Yeah. The first thing I do is ask if they're familiar with it, right? So I get to make sure that they're at least, if some people come to us through that process, so they've already come through it, I'll turn it back on them. Okay, after you take the evaluation, what are the areas you're most interested in? And I can kind of use that as the guide for what we want to talk about, right? If they say, oh, we really think we need better forecasting, I'll use that in the majority of the sales call to talk about our forecasting process. So it allows me to hone in a little bit better on what the client is coming to us for. And if they haven't taken it, one of the things I'll do is, okay, after we have this call, if you want to learn more about what we do, this is the best way to learn more about it, is go take the survey. It'll tell you all 5 areas where you fall in it. And hopefully what we just talked about makes a little bit more sense.
Yeah, very similar. With mine, I'm probably more on the, I let them talk a little bit, and definitely at the beginning, just ask, hey, did you take it? What are the areas? And then I kind of like lean into those a little bit. And then the only difference is, Jamie, I'm a closer. So at the end, I'm telling them not to learn more about us, but as soon as you start working with us, we're going to dial this thing in for you. But go ahead and take the preliminary one as I send you over the service agreement. But close. That's what I was looking for. You fell right into it. Thanks.
So excellent for prospecting. I do like the setup. Okay. So then onboarding, we had mentioned the 30 dimensions of 5. So it's a more intensive evaluation that we do. And I've gone through this very recently with a client. And my quick story would be, I was pretty worried about them being defensive just because of the first couple of meetings with the existing bookkeeper, that my impression was she was afraid we were trying to replace her. And she was anxious about this. So here I am coming to a maturity model, like she's not going to want to look bad. And the owner is there. The objectiveness was really good. And, the accounting, as you mentioned, or the financial reporting is the first section, and they were 1s and 2s on almost everything. But it was things like, do you have documented processes that are up to date? And she said, oh, they were, but that was before I had my baby. And that was 5 years ago. We haven't updated them since then. and I'm, making sure I'm is not trying to make her defensive at all. But it was great as we got to the end. And then we said, here's how we can help you. Let's prioritize these areas. So to me, that's one of the big learnings is the 2 times I've done it, people were not defensive when I thought they would be. I thought I've got the bookkeeper. This is their thing. They're going to want high scores and they're going to argue with me. That was good. And then turning around and saying, okay, let's help you prioritize. And then as we work through, like Jamie said, we're getting toward the end of onboarding, we're going to come back and say, let's go back through and here's where we think you are now. My expectation is we're going to show improvement in a lot of these different areas that are there. And so I'm hoping that that is another thing for them saying, okay, you hit your timeline. I've got the forecast of financial statements you promised, which is great. By the way, I also improved at the 30 dimensions. Maybe I improved in 20 of them over this 12-week period or 8-week period or whatever it was. Huge benefit, I think.
And that really leads to that long-term engagement that we've really always wanted with our clients, and we've always had it. But the question is like, okay, I've been working with you guys for 5 years. What have you done for me in the last year? And I think this really allows for us to have those conversations of beginning of every year. Like we always talk about the forecast, right? But again, that's not us doing the work. That's just us like creating the outline for them. It's like, okay, this year you're a $5 million company. Next year you want to be 7. That's the goals. So we've always had those conversations, but this allows us to peel back and have that conversation at a higher level and be like, what other goals do you have outside of just financial goals? You want to use new tools for pipeline or for sales outlook. Okay, let's do that. If you do that, that'll move you from a 3 to a 4, and you can kind of set those one goals each year that'll keep showing growth outside of just that onboarding period, not sure that outside of that first year. And I think that's what you were asking about with like long-term clients. Like this is something we're evaluating with all of our existing clients. And then we're kind of going back and at the end of it being like, okay, what are our goals? What's the next step? Where do we want to go next? And where do we want to go in that financial maturity, with the understanding that not every company's goal is to be 5s across the board. We understand that, but maybe moving from a 3 to 4 in one area will help them in a number of ways. And so it's really being able to have that long-term conversations with our client over a long-term basis where they see like, oh, wow, we're growing every year in our financial maturity.
Yeah. And, each of our CFOs have certain areas of strength. And this could help if I was just evaluating my clients, where I could go through each of those dimensions and say, they're not going to be a 5 on everything. It's a good exercise to say, should they be? Oh, I hadn't really thought about this particular area. This has always been a pain point. I can talk about this. And maybe, you mentioned pipeline. So maybe the tools in their pipeline, every month, they seem to have a challenge with that. What a great area to say, what we don't have is a consistent process that's integrated across your teams and things like that. Here's how I think it would help you. And maybe you get their buy-in to go there. So I'm thinking of it as a consulting tool. It can give me these ideas so I also don't become stale after a couple of years and just hit the routine of doing the same thing every time.
Okay, I think we're getting close to the end here, but I do have so I don't know if people ever listen to our podcast. I'm on a podcast for digital agencies, and the way we always end it is kind of with a fun question. And so I'd like to do the same here and throw it over to you guys. And so what I want to do is, I think one of the best ways for people to understand maturity model is think about it in other areas. And so for you two, the question is where in your life do you wish you had a maturity model that you could assess yourself on that would hopefully help you grow or become a better person? So Adam is thinking, so I think Tom might have an answer already. So I'm gonna throw it to you, Tom, first. Like, where do you wish you had a financial maturity or maturity model to evaluate yourself on?
Mine's probably so obvious with you guys knowing me this. It's been my analogy of maturity models. But if I think around sort of a fitness area, I can think of dimensions like strength or endurance or sleep or stress or things like that. I think if I look back, it would have been a helpful thing to say, okay, where do I really want to be? And realistically, at least for me, being at the top of every single one doesn't make sense. But there are places to say, oh, I could see progression, which I like to see in those areas. And could I move myself up in that area? So that's where I would like it to be.
That's a great one. I think that's going to resonate with a lot of people. I know where you think I'm going to go, but where are you going to go, Adam?
I was going to go with the kids, but like being a dad, but I'm going to keep it to the one that like pisses me off, which is golf. So there's definitely unfortunately, I've been low on the maturity model for a really long time, and we probably need to go see both. But yeah, you could definitely break that into a maturity model if you actually matured over the last 30 years, which I didn't. So anyway, so that's mine, golf.
I know you thought I was going to say basketball, but I'm not. Like, that's too easy. That's too easy of an answer. I've obviously thought about the
coaching basketball.
The coaching basketball, yeah. And my playing days they're way too mature. But no, I think it's your first answer. Like, the biggest thing for me is like in parenting, like where are the areas that I I do lack, where are the areas I can be better at, where are my strengths? And so that's something that I constantly think about is, okay, what areas could I be a better parent in? And honestly, like a better spouse too, like a family member, where are the items I support my wife in, and where are the ones I'm probably like, chores would be one of them. And I'm probably one across the board when it comes to every chore other than coaching basketball. So that might be one, like I probably could do a little more around the house. And so I think that's my answer, just to surprise you, Adam.
Yeah, no, good luck with that 360 review.
Yeah.
That's a good example though, Jamie, because I think what we often do is, if we don't think we're doing well, we're saying in every single area, I'm going to suddenly go from a 0 to a 10.
Yeah.
And it's just not sustainable. But
Right.
Could you pick maybe an area and get a little bit better, and maybe it becomes a habit and you pick something else, or really evaluate yourself for that versus just this sort of emotional, I'm going to be better everywhere.
Right.
Well, good. As
Awesome.
we get done, then you can go do some chores and improve yourself in that.
I expect to hear that. I expect to hear that you've really improved with your chore taking.
You can text Adrian and ask her.
Yeah.
Well, this is excellent. As people want to learn more, Jamie mentioned you can go to our website and you can find and actually look at and take the assessment. But we hope that's valuable for people, how they think of doing their consulting. And it's something that we've really doubled down on. I think it's going to be an important thing for us going forward.
Yep.
Thank you, guys.
Thank you guys very much.